Index funds are one of the simplest and most effective ways to invest, but many people don't really know how they work. In this video, I'll give you a clear, simple explanation of index funds and why they're popular among investors. An index fund is a type of investment that tracks a market index, and they call like the S&P 500 or NASDAQ. Instead of picking individual stocks, your money is spread across all the companies in that index. Because index funds include hundreds or even thousands of stocks, they automatically give you diversification. This reduces risk compared to investing in a single stock. Index funds usually have low fees because they're passively managed, meaning the fund just follows the index rather than trying to beat it. This makes them cheaper and easier to maintain. Historically, major indexes tend to grow steadily over time, while individual stocks can swing wildly. Index funds provide a more stable, long-term growth opportunity. For beginners, index funds are ideal because they don't require constant research or stock picking. You invest in the market, and over time, your money grows with the index. Many index funds pay dividends from the companies they hold. Reinvesting these dividends can significantly increase your long-term returns thanks to compounding. In short, index funds let you invest in a broad market, diversify automatically, keep costs low, and grow your money steadily over time. They're simple, effective, and perfect for both beginners and seasoned investors.